If you own multifamily properties in Los Angeles or San Bernardino counties, here's the question going into 2026. Are you still winning or are you just surviving? Because in 2025, we had a year where values didn't move in one direction across every corridor, but the financials and the rules absolutely keep changing. And when I say the rules, I don't mean just interest rates or expenses. There were regulatory shifts in 2025 that most landlords still haven't fully digested, including changes at HUD that directly affect Section 8 owners. We'll cover that later in the video. But if you have any subsidized tenants, you're going to want to hear this. So in this video, I'm going to do two things. I'm going to give you the big picture story of what actually happened in 2025, and then we're going to go corridor by corridor so you can see what the market did where you own. Now, let's dig in. Hi, it's Chris German and welcome back to the Apartment Dealer Show. This is our market update video, one of our most coveted videos we do throughout the year. And this is going to be our year in review, meaning we're looking back at 2025 and we're going to set up realistic frameworks for what to expect in 2026. Before we get into the numbers, a quick disclaimer. This is not hype and this is not speculation. This is real data and real transactions from someone who has spent the last 18 years representing multifamily investors like you in the purchase and sale of apartment buildings right here in Southern California. My wife and I also own multifamily properties ourselves, so we understand what it means to be in the trenches, dealing with day-to-day management, rising expenses, rent control, and regulatory pressures. Before I go any further, if you own multifamily properties, you're looking to own multifamily properties, I would suggest you subscribe to our channel, give this video a like, share it with your friends and family. The information I'm about to cover and that we cover on our channel is all things multifamily, all facets of owning multifamily, and it's purely educational for you, the landlord. So who's this video for? This is for those of you who live off the cash flow from your properties today, or you are building a portfolio with the goal of replacing your income sometime down the road. The data I'm going to walk through is meant to help you think clearly about your next move, whether that is holding, refinancing, expanding, or selling. And this is especially for the long-term owner, the investor who's held their properties for 15, 20, 30 years. You're sitting on significant equity, but you're also asking yourself some very tough questions. Why does it feel harder to run the same building? Is holding still the smartest move given everything that's changed? And if I do sell, where does the money go so I do not sacrifice the cash flow that I rely on? This video is especially for you because the ebbs and flows of this market matter more at this stage. You have less time to recover from any mistakes, and the decisions you make today have a much bigger impact on your long-term financial outcome. Now, let's dig in. So what did 2025 really mean for investors? Well, let's start with the part that nobody can avoid. Last year, the market continued what I call the reset, and the reset shows up in one place first, cap rates. When cap rates move up, values come down, essentially, unless net operating income rises faster to offset it. But with rent control here locally, that is beyond challenging. And this is where a lot of owners get frustrated because you can do everything right operationally and still feel like the market is working against you. Case in point, let me give you a simple example that explains why so many owners feel like they're working harder, but they're not getting ahead. Let's say you own a building producing $100,000 in net income, and let's use a 2-year hold period. The market was valuing that income at about a 4.5% cap rate, let's say to start, which would put the value with $100,000 NOI roughly at $2.22 million. Now, over the next 2 years, you do what good operators do. You manage the property well, raise rents 8% per year, 2 years in a row. And year one, your net income goes to $108,000. At the same time, cap rates move up because the market adjusts to around 5%. Even with higher income, the value is now about $2.16 million. By year two, your net operating income goes up again because you gave another rent increase to $116,640. But cap rates have expanded further to about 5.5%. When you apply that cap rate, the value comes in at approximately $2,120,000. Here is the key takeaway. Over 2 years, income increased by over 16%, but the value of the building still declined by about $100,000 or roughly close to 5%. And that's not because rents did not grow. It's because cap rates expanded faster than your income. That is why so many owners feel squeezed right now. You could be doing everything right, again, operationally, and still see pressure on your value. In this market, strategy matters more than it has in a long time. But here's the opportunity embedded inside of that. If cap rates are higher, buyers are underwriting harder. And that means the owners who can drive NOI are the ones who will win at the end of the day. So the game in 2026 is not just owning apartments. It's owning apartments with a strategy that matches the new underwriting and being very intentional about your rental increases and capital improvements. Now, next, the Fed is not riding in to save values. Let's talk interest rates. A lot of owners are still thinking once rates drop, values will snap back. Maybe, but it's not going to happen overnight. And heading into 2026, we start the year with the Federal Reserve holding rates steady. No immediate relief is on the books. So my takeaway for you is simple. Don't build your plan around a rescue. Build your plan around what you can control. So what can you control? You can control, again, your net income, your risk exposure, your rent strategy, your debt structure, if you have financing that's coming due, and your tenant profile. Now, we have another video here that I'll point you to where I walk through this more in depth in terms of the change in interest rates, how that affects the market. But the bottom line is, don't wait on that to be your saving grace. The tenants have changed. This is another dynamic of ownership here lately. So one of the biggest shifts since the pandemic is that tenant preferences are not the same. The tenant profile is not the same. Their preferences are not the same, especially around unit size and what they'll pay for. Nationally, one of the themes being talked about is the demand leaning more towards larger units now, 2-bed, 3-bed units. Are people doubling up? Is it because there's more people working from home? It's probably everything in between. And what's been built is a mismatch for the market, and that matters because it changes who competes best in the rental market. Now, are those national numbers identical to LA and San Bernardino? Not necessarily, but the principle is very relevant here. If your unit mix and your offering don't match what today's renter is prioritizing, you'll fill it first. You're going to fill it in longer vacancy. How many of you have had challenges filling vacant units? It's taking longer. More concessions. How many of you, for the first time, maybe in, say, 15 years, have had to offer concessions? There's going to be more resistance, more pushback from the tenants in terms of the finishing touches of your unit. So the unit improvements matter. And we have plenty of videos on the channel where I walk you through my own unit improvements, and I show you how you can get your units rented that much more quickly at above market rents. Now, let me back up to concessions for 1 second. Right now, concessions and competition are a real thing. And this is something a lot of, especially LA County, San Bernardino County owners they're not necessarily used to this of late because they've been spoiled. They're used to just put it up for rent and it rents. But we're in an environment where concessions and competition became part of the conversation again, especially where new supply is heavier. So the operational message in 2026 is this: you don't just own units, you own a product. And the people who treat it like a product, desirable units, strong screening, smart upgrades, tight expense controls, they're the ones that are going to protect their net income, their NOI. Now, let's talk about regulations. Have they changed? Yes, even when it comes to refrigerators, of all things. Because a lot of owners are feeling the margin pressure from 1,000 cuts, property insurance, repair costs, compliance, and new requirements that didn't exist when they originally bought the building. That's cutting into their cash flow, their take-home cash flow that you put in their pocket and go down to Sprouts and buy the groceries, right? And here's one that's simple but expensive at scale. Starting this year, January 1st, California requires most rentals to have a working stove and refrigerator in connection with certain new renewed or amended leases, and there's some specific exceptions. But essentially, you now have to provide a refrigerator and a stove in every rental unit that you own. So again, I'm not saying that one law breaks the deal. I'm saying it's another example of the bigger truth. The rules have changed. The financials have changed. The tenants have changed. So the only question is, how about your strategy? The strategy that worked 30 years ago, buy it, ignore it, and win by default, that does not work anymore. That's not going to work in 2026. All right, now with that in mind, let's go corridor by corridor. And I'll show you what happened to price per unit, price per square foot, GRM, and the overall trend across the last 3 years. And as a reminder, as we go through the information, remember, different corridors behaved differently. So your plan has to be local, not generic. So now the information, I chunk it down by corridors, geographic corridors, and we lump specific cities together in these corridors for 3 reasons. One, values typically are about the same, rental rates are about the same, and the tenant base, the tenant demographic is about the same. All right, so what are these corridors? We have the East Los Angeles corridor, which consists of Boyle Heights, East Los Angeles 90022, and El Sereno. The 710-91 corridor, Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, Southgate. The West San Gabriel Valley, Rosemead, San Gabriel, Temple City. The Eastern San Gabriel Valley, Azusa, Baldwin Park, Covina, El Monte, Glendora, Laverne, Monrovia, South El Monte, West Covina. The 605 corridor, Bellflower, Downey, La Puente, Montebello, Norwalk, Paramount, Pico Rivera, Whittier. The Inland Empire West, Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, and Upland. And the Inland Empire East, Bloomington, Colton, Fontana, Rialto. Now, you might only have interest in one particular corridor that we're going to cover. Check the chapters below here on YouTube. Jump to that corridor, but come back to me at the end as we're going to cover some major changes that affect everybody no matter where you own or where your interest lies. All right, now, let's start with the Western San Gabriel Valley. Okay, the Western San Gabriel Valley. Now, in 2025, there was a total of 17 sales. The total sales volume, if you added up the total prices of those 17 individual sales, would bring you to a little over $46 million. As we look at price per unit, we're looking at a 3-year trend. In 2023, the average price per unit sold was a little over $310,000. 2024, $295,000, and then 2025, $334,000. When we look at so over the last 3 years, value price per unit went up about 7.7%. When you look at cap rate over a 3-year run, we start out in 2023 at 4.95, we go to 4.2, now we're at 4.9. So cap rates have actually decreased in the last 3 years by about 9.3%. When we look at GRM, gross rent multiplier, if you took the total gross rents, how many times would you have to multiply them to equal the price, the sales price? We started out in 2023 at 17.5, then we went to 15.71 in 2024, ending in 2025 at 14.68. So GRM dropped by about 16%. When we look at price per square foot, we started out at $365, we hit $397, and then we hit a jump to $436 per foot. That was over nearly about a 20% increase when we're talking about the price per square foot on the average of the sales. Now, the Western San Gabriel Valley, this corridor is the standout. You see pricing strength in 2025 compared to 2024. And over the 3-year period, it's one of the stronger trajectories that we're going to see here. But here's the thing, even in a strong corridor, GRMs came down over the 3-year period. So again, it's not just about price. Buyers are still paying attention to income. Now, here are your rental rates for the Western San Gabriel Valley. Choose your city, bedroom count, pause the video, take a look. These are the average rents. These are a collection between Rentometer, Zillow, CoStar. These are the averages, again, just averages. Let's move on to the Eastern San Gabriel Valley. In 2025, there was a total of 59 sales. Those 59 sales equated to nearly $163 million in transaction volume. The average price per unit in a 3-year run, 2023, we were at about $286,000 per unit. 2024, $287,000 per unit, not much difference. Then dropping last year to $271,000. So if you watched my market update videos over the last 2 years, you know that I said that, hey, the Eastern San Gabriel Valley continued to hold strong. It continued to outperform its counterparts. It did not go unscathed though, because now prices have come down over the last 3-year run by about 5% or so. Cap rates. We start out at 4.53, then we jump to 4.66. Last year, we were at 5.29. That's an increase in the cap rate of 16.8%. And this is a good point here, those of you that are looking to purchase, because again, if you're talking about values have came down by 5% just in the last 3 years, it's greater than that if you take a look at if you take a look over the last 5 years, and the cap rate has increased by over 16%, could amount to a buying window. GRM 14.9, 14.3 to 13.26. I didn't think that we would once again return to 13 times gross in the eastern San Gabriel Valley. GRM has dropped by 11%, but that's where we are now. Price per square foot, 338, 346 to where we are now, 324. Again, it's a little over a 4% drop. In this corridor, we're tracking about 1,871 buildings. In terms of your rental rates, here's your rental rates. Choose your city, bedroom count, pause the video. These are averages. So the eastern San Gabriel Valley, what stands out here is a softening into 2025 after being relatively stable, like I mentioned, from 2023 to 2024. Price per unit and price per foot both dipped in 2025 and GRM compressed, which tells you the market is still underwriting tighter. And again, that's what I mentioned at the onset of this video. Buyers are underwriting the financials much tighter. Now let's move on to the East Los Angeles corridor. In the East Los Angeles corridor, we had 21 sales in 2025. The total of those sales was about $24.5 million. When we take a look at a 3-year run on price per unit, what happened here the last 3 years, we started out at $196,000 per unit, $190,000 per unit, to $177,000 per unit. So values dropped about 10%. We look at cap rate, we went from 5.2 to 6.39. That's over it's about a 23% jump in terms of cap rate. And when you look at GRM, we went from 14.39 to 12.7 to 11.7. That dropped over 18% over the course of 3 years. Now, in this corridor, we're tracking about 690 buildings for this information. With respect to rental rates, take a look here, find your city, locale, bedroom count. Those are the averages. Now, in the East LA corridor, same story. Pricing pressure, GRM compression. And East LA is always a corridor where strategy matters most because of the local dynamics, local rent control. It can create very different outcomes depending on your exposure to rent control, your tenant profile, and the building's condition. If you're a long-term owner here, your edge is not the market. Your edge is management and repositioning your equity if it's something where you're looking to increase your appreciation and cash flow over time. Now, the 710-91 corridor. In this corridor, we're tracking a little under 2,500 buildings. Last year, there was 43 sales. Those 43 sales amounted to about $79 million in total volume. The price per unit in 2023 starts out at $223,000 per unit, drops to $208,000, stays steady around $207,000, but overall in a 3-year run, values in the 710-91 corridor dropped by about 7%. Cap rates, though, went from 4.8 to 5.28 to about 6%. That was, call it a 25% increase in cap rate, right? So cap rate, the rate of return, if you were to buy a building all cash, that's your rate of return. In this corridor, it's gone up 25% over the last 3 years. GRM went from over a 3-year period, 13.2 to 11.36. That's a 14% drop in GRM. And price per square foot went from 328 to 310. That's about a 5.5% drop. For your rental rates, again, find your city, go across, find your bedroom count. These are the averages as of the recording of this video. So this corridor overall stayed under pressure literally all 3 years, right? You see the price per unit down dramatically over the 3 years. And the GRM compressed meaningfully as well. So for the long-term owner in this corridor, the question is not, did the market save me? It's, how do I protect my net income and reduce risk while I decide whether holding in this area is still ideal, or is it better to move to another location? Because what this area has been plagued by primarily is that most of the cities, Bell Gardens, Maywood, Huntington Park, they have individualized rent control. The minute that came into place in those areas, values plummeted. So that's bringing the entire corridor down in general. So as an investor, you have to ask yourself, if I could sell, exchange, move my equity to any other neighboring city that doesn't have localized rent control, I can raise my rents by 3 times the amount. Why wouldn't I do so? I hope you're not tied to a specific address, right? 123 Mellon Street, right? It is bricks and sticks and nails at the end of the day. You could take that equity and move it into a different building, or move your equity from one bank to a different bank that's paying a higher yield. That's for you to make that judgment call. But I think that's what's on the table here, because the writing's on the wall. It isn't a 1-year thing, a 2-year thing. This has been a trend for some time. Now, the 605 corridor. We had 79 sales in the 605 corridor, and the total sales volume in 2025 was over $215 million. Now let's take a look at price per unit. We went from $275,000 per unit in 2023 to $244,000 in 2024, big drop, to then again last year to back to $258,000 per unit. When you take a look at cap rate, it's steadily increased though. If we start out about a 4% cap rate in 2023, jumping to 5.21 and then 5.244, that's about a 30% increase over the past 3 years. GRM, 14.73, drops to 12.9. That's a change in about 12.4%. And then, of course, price per square foot did the same thing kind of that the price per unit did. It was higher, drops, comes back around. Now, with respect to rental rates, find your city, bedroom count, take a look. You have a vacancy. This will help figure out what at least is the average. If you've done a lot of improvements to your building, hopefully you're able to get above average here, but this is a place to start. Now, as I mentioned, this is a story of a big drop from 2023 to 2024, and then a partial rebound in 2025. That's what a reset looks like. Down, then stabilizes, then selective recovery. GRM compressing over 3 years is consistent with the theme we opened with. Income and underwriting matter more right now than they have in the past. And so this, again, is the same trend, right? We're seeing this corridor after corridor, that essentially the cap rates, the overall yields of properties have increased as we take a look back over the course of the last 3 years. Okay, now the Inland Empire West. Here we had 20 sales last year for a total of little over $38 million in total sales volume. And the price per unit dropped about 10% over the course of the last 3 years. But we started out at $256 a unit, dropped to $213,000 per unit in 2024, and then increased back to $231,000, right? So we saw a drop and then a partial rebound. Cap rate, though, has steadily increased from 4.77 to where we ended last year to 5.58%. GRM, steady downward trend from about 15 to where we are now to 12.25. That's over an 18% change. And price per square foot, we saw the same thing where you see a drop and a rebound, and we're tracking about 1,123 buildings here in the Inland Empire West. Here's your rental rates. Find your city. These are the averages. Hopefully this helps you fill your next vacancy. This corridor showed the volatility we've talked about before. You had a big step down in 2024 and then a rebound in 2025, especially in price per unit. That's why the Empire fills the waves more aggressively than, say, some of these other corridors. When sentiment shifts, it shifts hard in the Empire, and you consistently, you see that over time. Now let's transition over to the Inland Empire East. In the East Inland Empire, we had a whopping 5 sales, and there's not always a lot of sales in the Inland Empire East, but we had 5 for a total of over $21 million. When we take a look at price per unit, interestingly enough, we went from $246 to $214 to $324. Now, there's some outlier sales there, some newer construction sales. So again, if you own a building in Bloomington and you're saying, wow, I cannot believe my building is now worth over $300,000 per unit, it's not. Some newly constructed buildings sold at those ranges. Cap rate went from 4.42 to 5.43 over the last 3 years. GRM from 14.91 down to 12.47. That's over a 16% change. And of course, we saw ebbs and flows with the price per square foot, where we come down and then came back up partially. Now, with respect to rents, here's your rents. These are the averages. Again, Rentometer, Zillow, CoStar. These are the averages between the three, a starting point for your next vacancy. Now, the East of the Empire, this is a wild one. A big drop into 2024 and then a major jump right in 2025, depending on the data you're looking at. And so when you see moves like this, the real takeaway is not it's up or it's down, it's what's driving the comps. Because 1 or 2 outlier sales can change averages very fast, and especially when the sales volume is thin. So if you will own here, you want to treat corridor averages as a starting point and then look at true comparables in your immediate micro market. At the onset of the video, I mentioned that there's been a big impact to Section 8 tenants. So I want to pause for a moment and talk about exactly what's going on, because it's not really been widely discussed as of yet. But it's important, especially if you own property that has Section 8 tenants, or you're receiving housing assistance, or you have exposure to anything that happens within that demographic. At a high level, HUD is in the middle of what I would call a cleanup phase for landlords here locally. This is not just about budget numbers or funding headlines. The bigger shift is stricter eligibility enforcement and a possible move towards state-level control over housing assistance. So here's what's already in motion. On the 23rd of this month of January, HUD issued a directive requiring local housing authorities to verify tenant citizenship within a 30-day window. Practically speaking, that means if you have Section 8 tenants, your housing authority may start requesting updated documentation. HUD is now using a tenant match system that cross-references the Department of Homeland Security records, and if a tenant is found ineligible, the voucher can be terminated. Beyond that immediate audit, there are several proposed policy changes that investors should be aware of. These include a 2-year time limit on assistance for able-bodied adults and new work requirements tied to eligibility. There's also a proposal to move Section 8 into state-level rental assistance block grants. If that happens, the rules around vouchers will no longer be uniform nationwide and can vary meaningfully from one state to another. So what does this mean for you as an owner? With a proposed reduction in HUD's budget, the likelihood is fewer vouchers, tighter enforcement, and less flexibility at the local level. If subsidized rents is part of your income, this is the time to understand your exposure, review your rent control, and stay in close contact with your local housing authority. This is not about panic, but it is about being proactive in an environment where the rules are clearly tightening and changing. All right, so let's bring it home. Here's what 2025 really taught us. The market is still repricing. Cap rates are up, GRM is compressed across corridors, no matter basically where we looked. Interest rates, are not a magic switch. And we're starting 2026 with rates held at the first Fed meeting. So don't plan on an overnight snapback. And I would say, even if interest rates do trend downwards over the course of this year, it will take some time for us to see a meaningful change in the direction of the market. So just be cognizant of that. Operations matter more than ever. If you can grow your net operating income, you can protect value, even in a tighter underwriting environment. So keep in mind your tenancy, rental increases, capital improvements. Regulations keep stacking. Even something as basic as appliance requirements becomes real money at scale. So again, you want to make sure that you've budgeted for these things, you know the local laws, you know the trends and what's changing as it can impact your net cash flow. Corridors are behaving differently, so strategy has to be local. And one more micro idea to keep in the back of your mind as we go through 2026. If we're truly moving into an environment where the economy can grow without strong job growth because of labor constraints, policy, technology, then underwriting has to get more conservative and more local to the areas that you're looking to invest. Meaning, don't underwrite your next move on headlines. Underwrite it on real demand drivers in your city, your tenant base, and your rent roll. That was a lot of data. Thanks for nerding out with me. But I think this is where we can bring it home. You are probably one of 3 investors. Either you're currently working or running a business like my wife and I. So you're purchasing multifamily properties or hope to, so that income can replace you as a working individual sometime down the road. So your rental increases over time matter. Where you own matters because of the trajectory of that appreciation, right? You need long-term appreciation. And as we've learned, if you have localized rent control in one area or another, it definitely impacts value. Second, you may be currently retired. You're living off the cash flow. So any meaningful change that you can see in your net income is a direct correlation to an increase in your standard of living. Well, what's your strategy? What's your strategy to keep up with the pace of inflation? to keep your net income of the properties up with increased cost of owning the properties themselves, insurance and everything else? What's your strategy? Again, many of my clients will tell you that they bought a building 30 years ago and then just hung on for dear life, and today they're walking around a self-made millionaire. They look like a genius. To go about it that same way, unfortunately, I wish it was that way, make things a lot easier for me in my investments, but that's just not the way it is, right? So we have to be more proactive. We have to have a strategy in place. And maybe you're part of the third type of investor who right now, you showed up to this video saying, okay, I want to see what data Chris shares. I want to know exactly how much my building's worth because I'm thinking about selling. Maybe you're thinking about selling because your kids have no interest in the properties. Maybe you're thinking about selling because you are looking to set up your children, but you have to move the assets around because maybe you own 1 or 2 large buildings. How do you split that 3 and 4 ways? There are strategies, to make that happen. Maybe you're considering, hey, I'd like to sell. Now you hear about Section 8 and refrigerators. You're like, even that's the straw that breaks the camel's back. I want out. But what do I do about capital gains tax? What do I do about this cash flow that really is my means of survival? There's strategies for that. So no matter which of those 3 investor types that you are, I've been involved in more than 400 multifamily transactions over my career. I've worked with investors of all size in terms of working with a couple, maybe that own a duplex, and they have aspirations of owning a large portfolio, to one of my clients is one of the largest multifamily investors here locally in Southern California, and everybody in between. My team and I help these investors, these landlords that are just like you, to strategize what's the next best move based upon their long-term goals. How can we increase the speed at which they're able to achieve their overall financial goal, the building of their financial legacy? If you have questions, you're curious as to, okay, we went through the data, what does that mean specifically to the value of your property? Given that value, what could you do with that equity today? Given the fact that it's a buying opportunity in many of the corridors that we went through, cap rates are up, prices are down, meaning in some meaningful amounts, depending where we're talking about. Can you reposition that equity? Increase your income, say 10, 15, 20% overnight, just by moving where the income is invested. And then what would that mean to the long-term appreciation? Maybe you own in a heavily localized rent control area, and you're saying, yeah, I want out. Raising rents 2-3% a year. Nobody's getting rich overnight that way. I want to move my equity, but where? What's similar to an area that you would understand that you've owned in, say, for several years? Or again, for those investors that are looking for an angle, a strategy, an exit strategy where you can keep your cash flow in place, minimize the capital gains tax should you choose to sell and exit. We have helped investors do everything in between. That's why the apartment dealer exists. That's what my team and I do day in and day out when I'm not recording these videos. So please reach out to us for a free private consultation. Put all my knowledge to use, all my experience to use, and to help you, your family, your heirs, your partners achieve the financial legacy that you started out with in mind anyways. This is why you took on the yoke of owning multifamily properties. Let's get there faster. Let's get there in a much more efficient way. If you found today's video helpful, be sure to subscribe to our channel, turn on alerts, like this video. Plenty of more content coming like this and better over the course of this year. And I would also suggest you watch one of these 2 videos. It's only going to compound on what you've already learned. And this is Chris German from The Apartment Dealer, wishing you positive cash flow, tenants who behave, and a financial legacy you can be proud of. Till next time.